Good morning. Good morning, Alec. Good morning, everybody. My name is Perry. I'm head of the technical training at the Singapore College of Insurance. On behalf of SCI and, of course, Kita Insurance, we warmly welcome everybody to this webinar today on non-payment insurance. Right, so today's title is Non-Payment Insurance, Supporting Carbon and Climate Project Financing. First, let me introduce the speaker for today. Today, we are very privileged to have Mr. Alec Pillay. Mr. Alec Pillay is from, of course, Kita, where he specializes in underwriting of carbon insurance solutions. And he focuses on developing insurance products that mitigate risks associated with carbon credit transactions, supporting the growth of carbon removal projects. He has also shared his expertise in industry events, such as the PLUS webinar titled Gross Written Carbon, the Role of Insurance to De-risk the Carbon Markets, where he discussed the critical role of insurance in the carbon markets. This shows the synopsis of today. So today, we're talking about non-payment insurance as a risk transfer solution, as you can see, and we are providing a practical, non-technical overview of how this form of insurance can complement existing financial and risk mitigation structures when we are transiting to a low carbon economy. Before we start, here are some other sustainability, energy, renewable related courses that you may be interested in attending. Take note of the dates and the titles. We have at least 3 courses ranging from renewable energy projects and also environmental risks. These are in July, October, as you can see. And if you need further information on these courses, please contact us. Poll, let's have a couple of polls at the beginning. Can we have the first poll, please? Thank you. First poll says, what is your primary interest in this session? There are 4 choices. I will give you 10 seconds to just click your answer. And we will display the results of the poll very instantaneously. Okay, let's close poll number 1. All right. Okay. So basically very interesting. Uh, Almost, I think majority said general interest, followed by exploring insurance solutions for climate projects, and then followed by understanding carbon markets and credits. Okay, thank you for taking part in that poll. I think we have another one, right? Yes. Next poll. What is your level and familiarity and activity with respect to climate risk and the carbon markets? You can see 4 choices shown here. There's no right or wrong answer, just indicate how you feel. Okay, let's close poll number 2. Okay, let's look at the results for poll number 2. We are evenly very close between, in fact, it's identical between the first 2. 37% each chose options 1 and 2. So majority of you said no real familiarity, and some said limited familiarity. Okay, that will give Alec a good idea of the level of familiarity of our target audience. Thank you again for participating in poll number 2. Let's close poll number 2, please. Thank you. All right. Next slide. Okay, without much further ado, let me hand it over to our speaker for today, Mr. Alec Pillay from Kita. Over to you, Alec. Hmm? What? I think there appears to be a connection issue. Let's wait for Alec to come back on. I think he'll be rejoining again. These things do happen sometimes owing to certain technical issues. Appreciate your patience while Alec will rejoin us again. Uh, in the meantime, Darren, you may want to flash the courses that we have. Yes, thank you for putting the links to our courses in the chat box. And if you wish to explore these courses, you can click these links and you can keep in touch with us if you have any other interests or seek other courses related to carbon or in fact renewables or ESG related issues or courses. Just wait a few minutes for Alec to rejoin us, okay? I see Alec back now. Alec, are you back with us?
I am sorry, Perry, having an issue with my Zoom on my laptop, so I've joined from my phone for the time
No
being.
problem. Okay, all right, sure. Basically, are you able to share your slides or would you like Darren to do so?
I'll ask Darren to share the slides,
Okay, Darren,
if that's all
please
right.
show the slides and operate the slides while Alec does his presentation, please. Thank you. Okay, the slides are on. Over to you.
Thank you very much, Perry, and thank you, Darren, for sharing the slides. Good morning and good afternoon to everyone who's joined. Apologies for the technical difficulties to start things off, but thank you everyone for joining. So Darren, if you would like to move on to the next slide. So a bit of an overview about Kita. Thank you, Perry, for an overview of myself previously. But as Perry said, I lead the underwriting team at Kita. Kita is a cover holder operating out of Lloyd's of London, here in London, with a focus on insurance for the carbon markets. So we launched 3 and a bit years ago, underwriting our first core product, which was a focus on the non-delivery insurance. And since then, as you can see here, we have expanded that product offering out to quite a number of different insurance products, focusing on different risks within the carbon markets and climate sector, but also a number of risk advisory services too. Now, today's session is focusing on non-payment insurance. As a bit of background on the product for those who may not be familiar with it, non-payment insurance, unlike some of Kita's other products, it is not a product that we developed, sort of designed or built. There is very much an established insurance market for non-payment insurance. What we have done at Kita is apply our risk models and our understanding and knowledge of carbon market specifics to this existing insurance market and taking a lot of the traditional non-payment insurance techniques, processes, and reapplying them here with a particular focus on carbon markets and climate. Very happy to talk about other products that we offer in due course. Please feel free to reach out through us directly or indeed through Perry. But today we'll be focusing on non-payment insurance. And if we move on to the next slide, Darren will just give a bit of an overview about the carbon markets and a bit of a recapper and why we think there's such an opportunity here. And why it should be something that people are interested in and paying attention to. So here you can see the various different estimates for growth opportunities and total addressable market for the carbon markets. As you can see, they do differ in sizes, with some being really quite aggressive and others being slightly less so. But the sort of the nominal value that we are looking towards is this number of $1 trillion by 2050, and that has been arrived at through the climatic requirements to hit net zero by 2050 and the volume of tons of carbon that need to be removed to hit that target, and an average sort of price of $100 per target. Per ton of carbon that is removed. So that gets us to $1 trillion. Even if we only get halfway or a fraction of the way towards that market size, that is still a very sizable market, and there's a huge opportunity for those investing in that space, but also there's a number of risks involved, and as a result of that, there's a large opportunity for the insurance sector to support this market. And so on the next couple of slides, I will give a bit of a recap of some specifics of carbon projects. So if you wouldn't mind moving on, Darian, please. So this is a bit of an overview here about some of the key features of carbon markets, just as a bit of a recap. So you can split the carbon markets into two core types, one being compliance and the other being voluntary. Compliance markets are governed by a regulator. They tend to be geographically focused and geographically specific. So as an example, the European Union has its own compliance scheme. California in America has its own compliance scheme. China does in the Asia Pacific region, and increasingly so, different countries are imposing their own compliance schemes. The voluntary market is slightly different. It isn't governed by a central regulator. It doesn't have a sort of a regulatory scheme, and there is no requirement for companies to act or purchase voluntary carbon credits. One key difference in the voluntary carbon market is that each carbon credit generated is tied to a specific project operating somewhere that is actively removing carbon from the atmosphere or avoiding further emission of carbon. So when in the voluntary carbon markets, one carbon credit relates to 1 ton of carbon or greenhouse gas emissions that has been either removed or indeed avoided from being emitted. At Keta, we operate across both compliance markets and voluntary carbon markets, and we've seen a real increase in demand across the two. As both of these markets grow, there's an increased requirement, and this is true across all of these categories. As these markets grow, there is an increased requirement for the financing and the capital to grow these markets. And again, there's a real knock-on effect into the demand and requirement for insurance to support this. So I'll go. The next section here is nature-based versus engineered. I'll go into this in a little bit more detail in the next slide, so I'll brush over that for now. But you can see that here. We've split out some of the core project types that constitute carbon projects, particularly within the voluntary carbon market. So you can see here the left two constitute nature-based solutions. So forestry and blue carbon are sort of the two main subsectors of this. Forestry within itself, there's a number of different subsections of forestry, whether you are reforesting existing or previously forested land, whether you are creating new forests or whether you're protecting existing forest land. Within the blue carbon world, that is a reasonably broad section of projects, but with a focus on coastal regions and ocean projects. So this is something that has become increasingly popular over the last few years, and actually regionally is an area that Asia Pacific has got a vast wealth of resources already, and a vast number of projects that are being targeted for growth within the region in the blue carbon sector. So mangroves projects are probably the most common project within blue carbon, but increasingly so we are seeing seagrass cultivation and kelp forest restoration, which have huge carbon removal benefits, but also have a huge number of benefits to the wider communities and wider economy. And then the other section here we've highlighted is engineered carbon projects. These are all removals, and again, these are increasingly popular, because of the notion of permanence, which is sort of the longevity of the carbon removal. Later on, we'll discuss some of the key risks to various projects, but anything within the nature-based solution space is inherently subject to natural catastrophe risks. If you take a forest project, for example, any wildfire or any impact on that project like that could well result in the reversal of the carbon that has been stored. And that carbon is emitted back into the atmosphere as those trees burn down, for example. With engineered carbon removals, this is much less likely because of the nature of the removal process and indeed how the carbon is stored as a subsequent action. So as a result of that, engineered solutions and their carbon credits tend to come at a higher price because of the perceived quality and the durability of these carbon removals. But one key hurdle to engineered solutions, which remains the case and is changing slowly, but is the vast requirement for capital upfront, so high capex costs to implement these facilities. Direct air capture, some of you may already be familiar with, but that is one of the most permanent solutions to carbon removal, but it does have huge costs to implement a direct air capture facility. And so it is not yet as common as it could be. But that is one area where, as we'll discuss later, where banks and financiers are particularly focused, and indeed the opportunity for insurance is quite exciting. So we'll stop here briefly for a mid-session poll, I believe. Darren, if you could bring that up before we discuss some of the risks that might face these assets. Thanks, Darren. We just wait a minute or so to get the answers in. Okay, I think that's great. Probably good to try and get those answers out now, if we could, please, Darren. Interesting and always nice to see that the overarching opinion of KETA in terms of the key drivers of some of these non-payment risks is matched by those in the audience. So we also take a stance that project underperformance and delivery failure are most likely to be the key driver of non-payment risks. That is one particular reason why we think we're well placed to assess these, given delivery failure is the focus of KETA's core non-delivery insurance product. So we use a lot of the same risk frameworks and models to assess the non-payment risk. So thank you very much for that, Darren. I think we can close that and then move on to the next slide. Thank you, which highlights some of the core risks to a carbon project. This is true regardless of the insurance that is being required, but is a particular focus when looking at non-payment risks and non-payment insurance, given the comprehensive nature of non-payment insurance policies. So we won't get into the technical elements of non-payment insurance policies, but they act as a comprehensive coverage, and so de facto provide cover for non-payment risks that arise out of any real scenario. So we've split these two core sections of risks up, those being the risks to the physical assets and those being the risks to intangible assets and sort of the processes. So a carbon project, regardless of whether it is a nature-based project or an engineered project, they face particular exposure to natural catastrophe risks. If we're thinking about things from a nature-based solution, then this very much can be the sort of the burning down of a trees. We've seen some drought issues, we've seen some flood issues, all of which can impact the growth rates of the trees. And the growth of the trees is being the key driver to the volume of carbon that is sequestered, and indeed the volume of carbon credits that are issued. And that comes back down to the second point, and the point that was highlighted in the poll, is that the risk of underperformance and the risk of delivery failure being a key driver for some of the non-payment risks, because the ability to generate carbon credits and sell those carbon credits is often a key revenue stream for carbon projects, to not only keep them afloat, but also to provide them the cash to repay any debt that they may have, or indeed on other contracts that they may also have. This is true also for an engineered project, but perhaps from slightly different angle. So it does depend on the project type in question. But if we take biochar, for example, biochar machinery is a pyrolysis machinery that can be placed anywhere, and it uses natural feedstocks. You pyrolyze and burn essentially the feedstocks in the absence of oxygen and produce what is known as biochar, and it is a very stable form of carbon. Interestingly, you can, as a product itself, there's a huge number of uses for biochar. You can spread it on agricultural land, and it improves soil quality and improves crop yield. But it can be mixed into cement, and it can be used in water filtration. So there's a huge number of benefits to it. But those facilities in particular face a fire risk themselves. That is partly due to the volume of mechanical activity going on. It is partly due to the volume of natural feedstocks that are often held on site, and in some rare cases can be prone to spontaneous combustion. And so when we're looking at these things from a Keta perspective, as indeed do other insurers and other financiers, these natural catastrophe risks and the impacts they might have are a key driver of things we consider for non-delivery insurance, but also bearing in mind today's particular focus, non-payment insurance. We've seen instances where projects might take out individual insurance themselves against some of these natural catastrophe risks, and that can improve or it can reduce the likelihood of these risks, or the severity of the impact, and that's always looked upon favourably. One of the other key risks to a physical asset is supply chain risks. And again, this is true whether it is a nature-based solution and we're thinking about the supply of seeds for replanting, or seedlings, if the seedlings are being planted. And there have been examples where projects have underperformed or completely failed as a result of third-party actions or inactions. And this failure of the supply chain has been a key element in the project's ability to generate carbon sequestration and, as a result, carbon credits. But equally, again, from an engineered solution, again, if we take biochar as an example, the biochar facilities can only operate if they receive the feedstock that they need to. And as is the case for many facilities like this, whether it's an oil refinery or a smelter, shutting down the facility and operating below a certain percentage performance rate is really quite costly, because not least the lack of revenue that comes out of it, but equally there's often costs involved to ramp up production again later. So it is optimal to keep the facility performing at pretty high production capabilities. And so if there are disruptions in the supply chain, that can have quite drastic consequences on the ongoing performance of that physical asset. So that's something that we are always keen to look into when considering all risks to a carbon project. And the final point we've highlighted here from a physical asset risk is a combination of operational and machinery risks. Operational risks, again, are something faced by both nature-based projects and engineered. These can also, in some cases, relate to the performance of third-party agents that are coming in and supporting the project, whether that be planting some seedlings or operating the machinery or some other service along that value chain. And similar to supply chain risks, the performance of these third parties can be a key supporting factor or indeed a key negative in the overall performance of the asset. Something that we always pay particular focus to is the availability of replacements, perhaps, if that third party was to go insolvent or fail on their actions, how feasible is it that they could be replaced? And machinery risks, as I suspect everyone will have clocked, are only really a focus for engineered solutions. These are risks that are not really even specific to carbon projects, but are common across all engineered machinery, really. And there are insurances available for machinery breakdown and tech performance risks. But again, a key driver as to why these projects might not perform to the level that they are expected to perform. We also, on the second section of these risks, we talk about some of the intangible risks and the risks to the intangible assets. This is more a focus on the process through which a carbon project generates carbon credits, has those credits valued, and then indeed can sell those carbon credits to generate the cash to repay debt or whatever it might be. So it's a very initial process. Carbon projects will go through a forecasting exercise using the predetermined methodologies that are outlined by carbon standards that within the voluntary carbon markets act as sort of quasi regulators. It's the carbon standards that provide the methodology for each carbon project type. So, for example, if you want to operate an afforestation project, you can't just go and start planting trees haphazardly. There is a strict methodology outlined by each of the big carbon standards, or all carbon standards. That some of the most well known will be the likes of Verra and Gold Standard, and these will outline the strict method you must use to plant the trees. It will outline the distance between the seedlings, the work you must do throughout the growth, any silvicultural practices to be exercised throughout the project type. These will all be outlined in the methodologies, and a project will submit documentation outlining that its project plan is in adherence to the methodology, but it will also be checked on from an ongoing basis that it continues to operate in accordance with the methodology. But in some cases, these methodologies can change. And so there is an impact or a risk, perhaps, that there's an update in the science, the calculations around these methodologies. Perhaps there is a risk that these carbon standards have a change in management, or indeed, at the worst case, go insolvent and cease to exist. And so there is an inherent risk around that. That the process a project has undertaken to generate its carbon credits for some reason outside its control has now changed, and that might impact the sort of the future of the project, its ability to perform and generate carbon credits. The The final point in this first section is also about reserves. Now, this is talking about credits that might have already been issued, but perhaps not sold. And so in some cases, we'll talk a little bit later about potential structures from a non-payment insurance perspective. But in some cases, these reserves can be used by as collateral to loans, or in perhaps as security. But one key risk that these reserves of already issued carbon credits face is a risk of reversal. So this might be the fact that the forest that issued these carbon credits later burns down, and as a result of that, there might be some perceived concerns around these reserves of carbon credits. But there's also a reasonably significant pricing risk around these carbon credits. Carbon markets have been reasonably volatile over the last few years for a number of factors, and so an ability to assess the real value of these reserves is quite important when looking at some of these projects and getting comfortable with the profile of the project and indeed its operator. In some instances, these operators don't have balance sheets that are comparable to other commodity operators or other entities that might be looking to get financing. And so in many instances, it's the value of these carbon credits and the value of the project that can help get comfortable with the financial profile of these operators. The second bullet point here, from an intangible risk, focuses on the ongoing performance of a carbon project. And again, this is as was the first one. These are pertinent to projects regardless of whether they are nature-based or engineered. And it is the ongoing performance and the ongoing monitoring of these projects that will ultimately quantify the carbon sequestration and the carbon credits that will be issued from that project. These are almost always done by third parties, validation and verification bodies that are independently approved to come in and audit projects. But there is a risk here around, well, there's a number of risks here. One being the availability of VVB, a validation and verification body, to come in and perform that audit. As the volume of carbon projects grows, we haven't necessarily seen a corresponding increase in the number of reputable audit entities. So they are increasingly busy and have increasingly long lead times to conduct an audit. So there might be an issue in that case getting an audit at the time the project wants one, but equally there might be delays to that audit as a result of this sort of backlog. And I think that is something that is of particular concern to carbon projects at the moment, because there is this big backlog, and that can see a delay in their revenues. If there's a delay in their carbon credit validation, that will mean there's a delay in their carbon credit issuance, which knock-on effect is a delay in their ability to sell those carbon credits, and again a delay in their receipt of that cash. So that is a key element that we will look at regardless of the project type. When you're thinking about some of these very specific engineered solutions, there is even fewer entities that have the scientific capabilities to really dig into these projects and verify their efficacy. So that is something that is always worth bearing in mind, sort of from an intangible risk perspective. And the final one is a sort of a forward-looking risk. This is something that I think is always worth bearing in mind when looking at projects. But depending on the length of non-payment transactions or indeed facilities, these might be risks that are faced after or further down the line. So this risk of permanence is something we talked about previously. It is the risk of that the carbon savings are reversed. This can come in many forms. It could be the forest burning down. It could be the trees being chopped down by local communities and used for firewood. It could be in many of the engineered solutions, they feature geological storage of the carbon that is captured. So it will be pumped down and stored in aquifers underground. That then poses a risk to geomorphic changes and seismic activity that might disrupt the storage facility and release carbon back into the atmosphere. So these are all risks that might impact the future of the project going forwards. Invalidation risks are more pertinent with respect to the actions or inactions of the developer themselves. So there have been historically some instances of bad actors within the carbon space, as there are in most industries. But as a result of perhaps some fraudulent activity or overstating the benefits, there might be a risk of invalidation of the project at a later stage. And this usage point is something just to think about who is intending to use the credits and any potential reputational risks that might be party to that. So if we move on to the next slide, we sort of map out the risks over the lifetime of a project. Darren, if we're able to move on to the next slide, please. Thank you very much. So there's quite a lot going on this slide, so you'll have to bear with me as I sort of walk through it. But this is something we've done at Keta to try and map out the key risks that a carbon project faces during the lifetime. We've sort of put non-delivery as a sort of up at the top there, which really ties to the non-payment risks. As we discussed in that poll earlier, that I think that one of the key drivers of a project's inability to pay will be their inability to deliver the credits. So we sort of see the non-delivery and non-payment risks as almost one and the same here. This is at its highest at the very early stage of a carbon project, but as it continues through the execution phase and becomes more established, these non-delivery and non-payment risks, we believe, are continue to be reduced. And going forwards as well, the ongoing past performance of or positive past performance of a carbon project is a very good indicator of their ability to continue performing going forwards. So we've highlighted as an opposite trend the price risks that a project might face. Again, these are in opposite direction to the non-delivery risks, because at the project's early stage, they aren't issuing credits yet, so they're not too exposed to pricing fluctuations. But as that changes, that their exposure to volatility in price increases, and as a result of that, the risk for them increases too. This can have a knock-on effect to the risk of non-payment specifically, given the revenue, the main source of revenue for almost all carbon projects will be the sale of carbon credits. So if there is a negative price shock and for whatever reason they are unable to sell the credits at their break-even price, much like in other markets, that could be a very negative impact on their ability to repay whatever facilities they might have. Reversal risk, we talked about previously, permanence reversal. This is only really a risk once the carbon has already been sequestered. So there's a jump up in this reversal risk post issuance of the carbon credits. This is often something that is accounted for within the carbon standards. So it's not necessarily something that the carbon projects have direct exposure to themselves, but there may well be some knock-on effects from a reversal event, both in terms of the project's requirements to make good to the carbon standard, but also their future ability to deliver credits or perform their project. And again, that has a knock-on impact to any future non-payment risks that that project might pose. Counterparty risk here is something that we sort of tie to the non-payment risks a little bit as well. It is the performance of a carbon project developer, and in some cases their ability to repay and meet obligations. This increases throughout the lifetime of a project until the point that they have issued credits and are now actually realizing some revenue. At that point, a lot of carbon projects are of a stage that they're cash generating, and their counterparty risk is improved at that point, and they can often access financing and they can often manage their working capital and cash flow slightly better. In validation, we similar to reversal, this is not something that is faced at the early stages of a project, but increases marginally as the project becomes more established and as they issue credits. They continue to face this risk of ongoing invalidation, tied in particular to the actions of the project. We think compared to some of the other risks, this is reasonably low, but is always something to bear in mind. And the final one that we've highlighted here is political risk. This is something we haven't necessarily discussed earlier thus far, but it can indeed be something that is a real concern to carbon projects. Depending on the project type, they can often be located in jurisdictions that have high perceived political risk. And we're of the opinion that the more established these projects are, generally, the more well connected they are within the country, and in many cases, the more benefits they have brought to the country and perhaps the communities. And as a result of that, the political risks decrease over the lifetime. So if we move on to the next slide, Darian, I'll just give a very quick overview of some of the key things that we will look at when we're considering non-payment risks and non-delivery risks. Thank you. So we see this as a bit of a circular approach. We always want to be working with carbon buyers and investors, and in some cases from a non-payment perspective, lenders, who are familiar with the carbon markets and have done their own level of due diligence. We want to be engaging with entities that have are using the carbon markets for the right reasons, rather than others that might not be, and have picked the right carbon projects to invest in as a result of their own targets and strategies. That then leads us on to the individual project itself, and we do a detailed underwrite of that project from a technical perspective, modelling out our own understandings of the carbon credit forecasts. So in many cases, we will have our own numbers that we can refer and compare to the carbon project's numbers to see how likely we think it is that they will generate the carbon savings and the carbon credits that they forecast, and how likely we think it is that they will deliver those credits to someone and to generate the right cash. So that then leads us to the project developer assessment. This is a detailed assessment of the financial profile of the carbon developer. In many cases, project developers, at least at the moment, are smaller scale and perhaps newer than many other industries or in many other industries. So from a financial statement perspective, they might look challenging. But one thing that we're always keen to do is use our knowledge of the carbon markets and our technical assessment of the carbon project to sort of take comfort from the value of that carbon asset that a project might have, sort of digging further than perhaps just looking at the balance sheets. But we will also look at the experience of the developer, past past projects that they may have operated, and in some cases the performance of the experience of the individual management and employees. And then a final point that rounds this out is a detailed understanding and assessment of the individual contract that we are looking at. Non-payment insurance sits behind the carbon contract, the lending agreement, whatever contract that might be. And so the stronger that contract is, and the more contractual protections there are, not only is that better for the investor, the lender, the bank, but also as a result of that, it is better for the insurers sitting behind that bank and that contract. And so that's something that we have seen increasing trends in strength over the last 3 years, which has been really positive to see. These contracts are getting much more structured and much more sophisticated, which is great to see. If we move on to the next slide, Darian, I'll give a bit of an overview of one core example of lending structures within the carbon space and how non-payment insurance can be a key benefit. So this is a very simplified project finance structure where you will have a financer who is lending money to the project, the carbon project. Typically that is done through an SPV. So those revenues and cash are somewhat ring-fenced. That project SPV will typically sign an offtake to a buyer in this instance, and that offtake contract will agree to sell the carbon credits or sell a number of carbon credits, typically at a fixed volume and a fixed price, but not always. And it's the revenues from that sales contract that can often help the financiers and lenders get comfortable in lending the money against those contracted revenues. This is something that has been a real positive change in the carbon markets over the last couple of years, is the increase in these buyers who are signing offtake contracts. And as these offtake contracts increase in volume, that means there's much more opportunity for banks to get comfortable lending against those. And so there's been an increase in the financing available to carbon projects. And there's a few options for different insurance fitting within this structure. But the key one we're focusing on today is the non-payment insurance. This would insure the lenders themselves, the financiers, against the repayment risks from the carbon project. So we talked about some of the key risks to the project itself in its ability to operate, but there are some other risks here, and that might be the performance of the buyer under the offtake contract. If they walk away, that might impact the project's ability to generate their cash and make those sales and repay the debt. But there are a number of other things that might impact that payment risk, macroeconomic and other geopolitical things that might impact the ability to repay. But all things that form within the sort of the underwriting of a specific transaction. And our non-payment insurance is something, as I said earlier, is established and is often purchased by banks particularly, but also alternative funders and other financial institutions, and it brings a large number of benefits to these financial institutions. In some instances, the financial institutions are able to benefit from capital relief from the purchase of non-payment insurance as a result of the comprehensive nature of the insurance, and typically the strong credit rating of the insurer. And banks especially are able to almost swap out the credit rating of the borrower with that of the insurer. And so they have to that brings a lot of benefits for them internally. It reduces some of their costs and allows them to lend at a cheaper rate in some cases. But one other key benefit aside from that is the risk transfer that it brings to the lender, which can allow them to use their capital more efficiently and to deploy more capital to more projects. And that is one of the key benefits that Kita has set out to try and bring to the carbon markets to facilitate the additional capital being dispersed to these projects. So, for example, if a bank lends $50 million but is able to buy $40 million of insurance, they might be able to recycle that capital and redeploy some of that 40 million to another carbon project, and sort of bring about even more benefits, purely, or not purely, but largely because of the insurance they would be able to purchase. If we move on to the final slide, Darren, I will just give a thank you. Bit of a run through about some of the things that we have seen within structures that can make it sort of improve the quality of the structure, with the key design here to be reduce the cost of insurance. But these are all elements available to, especially to financial institutions when they might be looking to deploy debt facilities to a carbon project. These are all options available to them that, from a Kita perspective and a Kita opinion, reduce the risk of that transaction, and improve the quality of it, and as a result of that, can reduce the cost of insurance. So we've highlighted here at the end some key variables and some key considerations that we will have when we're looking at a non-payment insurance transaction, and indeed other transactions. But the length of the insurance is going to be a key driver in terms of appetite and costing. Indeed, the same for the limit that is required, and then the coverage, or actually skipping that one onto the retention. So how much is the client willing to take themselves, perhaps as a result of their familiarity with the project or their own due diligence. Geography is a key consideration, not least for the political risks, but also from the natural catastrophe risks, but also with a particular focus on carbon markets, how familiar that geography is and that government are with the carbon markets and how supportive they are. And then finally, project type, where whenever we look at an individual transaction, each project type has its own nuances, and while they all face the same risks across the board, there are specific risks that are of particular importance to specific project types. And so that also forms part of the assessment we do and consideration when thinking about appetite and pricing. I will stop there. Perry and Darian, I think that's the end of the slides. And I think that leaves us some time for questions if that's the next step.
Right. Thank you so much. And we do have some questions in the Q&A box. Let me start with the first one. Are there cases where the carbon projects have seen more than these risks? I'm not sure which risk is referring to, but it must be one of the earlier risks you have highlighted in the slides.
I'm sure there will be cases where the project has seen other risks, if that was the question. What we've tried to do here is pick out some of the key risks. It's a non-exhaustive list, of course, so there will be other things that have faced a project along its life cycle, and might impact its ability to perform as expected. But what I would also highlight as well is that these risks, they're ever changing throughout the lifetime of a project. And so some will become less important, some will become more important, and indeed there might be new ones that crop up along the way. So designed as a non-exhaustive list, and I'm sure there will be others that are out there. But that list will also change as the project develops, but also as the carbon markets develop as well.
Okay, thank you so much. Next question, could you please give us a tangible example of the political risk?
Yeah, happy to. So I think there's two key examples that I can highlight. One was the case in Zimbabwe, 2 years ago, I believe, there was an agreement from the government that carbon projects had essentially a tax requirement. They had to pay, I think at the time it was 5% of revenues from the generation and sales of carbon credits were to be shared with the government. And a lot of carbon projects had built their models, both carbon models but financial models off the back of that. The government then came out one day and said that had changed up to being a 40% tax on the revenues. And at that point, that's obviously quite a significant change, and that will have had a large knock-on impact to, in some cases, the feasibility of projects, but at the very least on the revenues that they will be taking themselves and the cash they have to repay any debt or to stay afloat. There's another example in Kenya where the government, the intention was for the government to issue an approval letter to a project, and for reasons that aren't entirely clear as of yet, that letter was not issued, and that has had quite significant impact on the project itself. And I think actually recently the project ended up going insolvent off the back of it.
Okay, next one. How do we ensure that all risks are covered for carbon project, or do we aim for a high coverage but never a full cover, as you can never cover all risks out there?
So it's an interesting one. Non-payment insurance operates on a comprehensive basis, so it operates to cover all risks unless it is excluded, and there are some standard exclusions that will be the case across the board. So I think that is an option from a non-payment insurance perspective. One thing that we are always mindful of, especially when looking maybe from a non-delivery insurance or other products, is that, as you say, there are a lot of risks out there, and so sometimes it makes more sense to insure a subsection of those risks. And from what we have heard and from client feedback, being able to buy some insurance is better than not being able to buy insurance at all. So there might be instances where we've said the natural catastrophe risks are too high. So instead of saying we can't do the deal at all, we can't insure it at all, we will say we just have to exclude those risks. And that insurance to many of our clients has still been very valuable, even if it's not as comprehensive as it could be.
Okay, next one. Can you share what is the basis of the sum insured and premium calculation for non-payment insurance?
Yeah, absolutely. Typically, non-payment insurance, the sum insured would be based off the lending amount. Typically operating on the basis of 90% coverage. So there would be a minimum of 10% that is held by the policyholder. Premium would often then be calculated based on the amount that is outstanding of that debt repayment throughout the lifetime of the policy. So non-payment policies can often be multi-year, and you would look at, typically speaking, you would look at the exposure schedule and the amount that is still outstanding under that loan, and calculate the premium based off that.
Thank you so much. And the next one, what is the typical underlying credit rating of the off-takers or buyers? Which type of counterparties does this typically include as at today?
Yeah, that's a very good question. The preference is always for off-takers to be investment grade, or as strong as possible. To date, some of the biggest off-takers for carbon projects have been some of the large tech companies, your likes of Microsoft, Amazon, and a number of others have huge requirements to purchase carbon credits as part of their net zero strategy, increased in recent years as a result of the AI boom. and the number of data centers they are building. So their emissions are skyrocketing, and so they're purchasing more carbon credits as a result of that. But they have constituted the main off-takers thus far for some of these deals.
Thank you. Next one. Does the offtake tenor align with the term of the lending facility? How do banks typically approach the debt sizing considerations?
It will depend on a specific facility by facility basis. The preference, both from banks but also from insurers, would be that the offtake contract is longer than the debt facility period or the repayment period, to give a bit of extra buffer if needed. In terms of debt sizing, people will have different opinions. Different banks will have different processes to reach that. But I typically expect it to be a function of the contracted revenues, and the sort of the cash requirements of the project.
Okay, next one. May I clarify who is the insured for MPI? Who pays the premium? Is it the bank who loans the investment funds to the project or project owner?
Typically, for non-payment insurance, it would be the bank. And they would be purchasing the insurance and paying the premium. We've seen some instances where there might be non-delivery insurance purchased by the project, which will improve the pricing of the non-payment insurance for the bank. But NPI is typically designed for financial institutions to take out on their lending.
Okay, next one. Alex, is the framework or white papers available publicly that you can send to us?
There's plenty of resources about the carbon market. So I get my question back to that would be it would depend on the focus of the framework and white papers. If it's more there's lots of resources out there about traditional non-payment insurance, and lots out there about carbon markets. Limited resources as of yet about this specific subject of non-payment insurance for the carbon markets. But it'd be a combination of the two, I guess.
Okay, all right. Next one. How do you pay in kind when carbon credit prices fluctuate?
So KETA has the ability to pay in kind, and those policies operate on an agreed value basis. So we pay out the quantity of credits lost at the price agreed in the insurance policy. So it builds in a bit of a pricing protection there, but it then also means, as highlighted, those prices can be quite volatile. So we wouldn't be exposed to huge spikes in pricing because our price is agreed in the policy.
Okay, this question is from Arian Pecci. How much non-payment insurance have you underwritten so far? Number of projects, total capacity provided. Can you give an example of financing where non-payment has been used?
So from a KETA perspective, we launched our non-payment operations at the end of last year, and since then we've bound a number of policies. I think we've hit 4 or 5 since then, working with a number of banks and other financial institutions. Some of those deals have been quite sizable, and the facilities themselves have sort of hit up to hundreds of millions. There was a well-documented project finance example for carbon in the US last year. So as a structure, that's a good example of this. If you Google or search for Chestnut Carbon project finance, that will come up. Yeah.
Okay, we have 2 more questions. Could you give us an indicative change of cost of capital with inclusion of each incremental provision, such as investment grade offtake or parental guarantee or prepayment?
I'm not sure I would go so far as to give a specific example or number on the reduction in the cost of capital for including some of those elements. We would typically see the cost of capital as being an internal element that a bank might experience. From my personal experience, cost of capital is actually most benefited by taking out non-payment insurance because that can reduce the bank's internal costs for that. I think prepayment's probably the least beneficial. Parent company guarantees can be very beneficial, but it does, of course, depend on the profile of the parent company who's giving the guarantee. And we've seen a range there. I think those would all have big impacts on the risk profile and ability for a bank to get internal sign-off, perhaps, and indeed an impact on the insurance premiums for that non-payment insurance.
Okay, the very last question here. One of those slides indicate that the insurance tenure ranges from 4 to 7 years. However, it appears that the risks associated with carbon credits increase over longer periods. Could you please explain how this is managed?
So some of the risks might increase over the period, but conversely, some of the risks will decrease. So some of the core risks from a non-payment perspective will be focused on cash generation and the revenue. And the more established the project and the longer it has been operating, the more likely it is to have a strong cash flow from its carbon credit sales. So that specific risk, which is probably the main driver of non-payment risks, we would anticipate improving over time. There are other risks that, as highlighted, might increase, whether that be sort of counterparty risks, perhaps, or reversal invalidation. At Keta, we do a detailed assessment of each underlying project, from a natural catastrophe, from a performance, from all elements. And one of the factors there is the length of cover that is being requested. And we've seen some instances where actually, slightly counterintuitively, having a longer policy can be better, because especially for nature-based projects, it allows some regrowth to a carbon project if there is an issue. So, for example, if there's a fire in year 2, but you have a 7-year policy, you've then got 5 years worth of regrowth to that project before you might experience any loss. And actually, the impact of that regrowth period can be pretty significant and can get a project back almost to where it should be at that point.
Okay, thank you so much, Alec. Thank you for sharing with us your valuable insights into non-payment insurance. And thank you to the audience for the flow of numerous questions that we have received. Was certainly one of the most lively Q&A sessions we have ever had in one of our webinars. We have come to the end of today's session. On behalf of the Singapore College of Insurance and Keta Insurance, I wish you a good evening ahead. Goodbye. Thank you, and see you next time. Thank you.
Thanks, everyone.
Thank
Thanks,
you.
Perry.
Bye-bye. Bye-bye.